Thanks for clicking. Both Canadian consumers and Canadian businesses think that inflation is going to remain high for the foreseeable future. This according to two new surveys released by the Bank of Canada, the Canadian Survey of Consumer Expectations and the Business Outlook Survey. The surveys come as the Bank of Canada is set to make its interest rate announcement on July 12th, with many predicting that the bank will be delivering another 25 basis point rate hike at that announcement. And although some are still asking when we should be expecting, almost pleading for interest rate cuts.
What's wrong with you?
Persistently high inflation expectations, and not to mention resurgent GDP strength, are likely to keep further interest rate hikes on the table for some time. So what I want to do today is go over the survey of consumer expectations as well as the Business Outlook survey, discuss what these surveys mean for the July 12th rate announcement, and then go over what to look for next. Speaking of next, it is the beginning of the new month, so we are expecting to get June's real estate data out from the local boards any day now. We'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into these surveys. First up, the Canadian Survey of Consumer Expectations, which showed that although inflation expectations are coming down, they still remain well elevated from pre-pandemic levels. If we take a look at the survey, we can see that inflation expectations surged upward in 2021 and 2022, reaching their peak in the third quarter of last year, and have since come down substantially. Canadians now think that inflation will be sitting at 5% in 1 year's time, 4% in 2 years, and then back down to 2.89% in 5 years.
Give or take.
And while news that inflation expectations are receding is no doubt good news for the Bank of Canada, they're still far too high for the Bank of Canada's liking, and still much higher than they were pre-pandemic, when current perceptions of inflation remained well anchored at 2%. Coincidentally, or not, the CPI during those pre-pandemic years, hovered around 2%, right where Canadians thought it was. A big difference from the 7% currently being perceived by Canadians and the 3.4% being reported by Statistics Canada.
One mouth, 2 ears, listen to each other.
Regardless, the Bank of Canada is going to be especially concerned with these inflation expectations, which it has said repeatedly it looks to when deciding whether or not to raise interest rates. The bank looks to these expectations as they want to stop the potential for a self-reinforcing loop, where Canadians expect inflation to remain high, so they spend money now, which puts upward pressure on demand and upward pressure on inflation, and on it goes. And on this, the survey found something similar playing out in the housing market, with Canadians believing that real estate prices are going to continue their upward trend. While house price expectations receded following the Bank of Canada's rate hikes in the beginning of last year, they appear to be resurging upward after the Bank of Canada's pause.
We shall double our efforts.
Given that the Bank of Canada cited housing market activity as one of the reasons for its most recent rate hike, the heightened sense of FOMO, fear of missing out, starting to permeate the Canadian market is definitely not going to be welcome news to the bank. With that said, although inflation and real estate expectations remain too elevated for the Bank of Canada's liking, it will like at least some of what it sees in the Business Outlook survey. While Bank of Canada Governor Tiff Macklem has been adamant that the bank wants to stop a wage price spiral from occurring, the survey shows that businesses are starting to expect lower than average wage increases. Further, demand for labor on the part of businesses is softening as businesses aren't selling as much. Firms are reporting less need to raise wages to attract workers, and by 2025-2026, businesses expect wage growth to slow even further. Taken together, if businesses and consumers are correct, by 2025-2026, inflation will be around 4%, but businesses won't be giving any raises.
I think a modicum of gratitude would not be out of line here.
So, all in all, if we look at the Canadian Survey of Consumer Expectations and the Business Outlook survey, inflation expectations are coming down, although they're definitely taking their time. But with all of that said, the clock is ticking on the Bank of Canada, on the central banks, to get inflation under control. The survey also found that mortgage holders are seeing their finance worsen following renewal, which definitely isn't a major surprise, but it is something that I think is going to be on the Bank of Canada's radar, even if they don't state so publicly. As we talked about before on this channel, the powers that be, OSFI, the Government of Canada, have been allowing the banks to extend amortizations ad infinitum, almost indefinitely, on mortgages taken out in 2020 and 2021. This has been called a ticking time bomb, as come 2025-2026, these mortgages will be coming up for renewal, as will holders of fixed rate mortgages. They will be coming up for renewal as well, and we're going to see hundreds of thousands of Canadians enter into a payment shock. If OSFI, if the government, if the powers that be don't want to see all these holders of variable rate mortgages with fixed payments, if they don't want to see all of these mortgage holders have their payments increase right now, then why would they want to see all of these holders of these mortgages have their payments increase in a few years when all of the fixed rate holders are having their payments increase as well? The government, OSFI, the Bank of Canada, I would assume, understands full well that if all of these payment shocks come at once, if all of these payment shocks come in 2025, 2026, they could very well have a real problem with the real estate market as well with the banks. And I think the Bank of Canada is going to do whatever it can to get that recession in early. It's going to try to shock the economy. It's going to try to get that CPI down in time for 2025 so it can be in a position that it can re-lower rates. Rightly or wrongly, I think the bank is going to make sure that this happens quicker than many had anticipated, as they don't want to see the shocks that will be coming to the system when everyone has to renew their mortgage at higher rates en masse. That's just my guess, and I don't think the Bank of Canada would ever admit it publicly. News that the bank is going to be lowering rates to save those who got into the market in 2020 and 2021 is not going to be very well received publicly. Given this ticking time bomb that's set to go off in a few years, combined with stubbornly high inflation expectations and resurgent GDP data, I wouldn't be surprised if we saw the Bank of Canada raise rates again at its next meeting. With that said, we'll obviously have an update out on that announcement on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.